Right. Good morning, everyone, and thank you for joining us for sort of another sort of Landbay UK economy webinar with Simon French. Obviously, many of you who've joined us a number of times will know Simon. This is probably his fourth or fifth, or maybe more, with us. Simon is chief economist and head of research at Panmure Gordon. Prior to which, he was an economist with the UK government. He was also a regular columnist in the Times, which I'm sure you've read his columns a sort of number of times. The format is really the same as usual. Simon will speak for 20-25 minutes, and then we've got sort of 25-30 minutes or so for Q&A. So that will bring us up to just before 1 o'clock. Please use the Q&A box and type your questions. We may do some Q&A on the way if it's particularly relevant, or if not, we'll do them at the end. So please do sort of type away. Obviously, we've had some news overnight or this morning on inflation as well, which I'm sure we'll talk about. And obviously, there's more news coming in terms of Fed, which I'm sure we'll talk about as well. But on that note, I will pass over to Simon. Thanks, Simon.
Thank you, John. Good afternoon, everybody. And thank you to the Landbay team for, I think it is the fourth, but it could be the fifth time you've invited me. So I will take that as a decent sign that I didn't disgrace myself in previous appearances. But as John says, to spend the next 20 to 25 minutes just going through my outlook for the UK economy, putting it in a bit of a global context, because as John rightly said in his introduction, particularly for interest rate sensitive parts of the economy, and obviously the Landbay business sensitive to that, financial conditions, interest rate conditions set by events outside our shores, particularly in the United States, but also in the last week we've seen that last holdout of negative interest rates, the Bank of Japan, leave that and move their interest rates to positive territory, and the potential impact that may have. So I'll start off, and if the slides hopefully be on your screen, my first of my four themes is just really to set the global context to the UK economy, talking about the fact that growth is starting to pick up at the start of 2024, and that is encouraging. But that has had the effect of delaying what most economists, not us, you can pull the tapes, we thought that it would take longer for central banks to be comfortable with cutting rates than the market had been pricing at the start of the year. And that is playing out, and partly because growth has picked up in Q1. Then moving to the UK, UK real incomes, so that is real adjusting for inflation, which, as John rightly said, we got data out at 7 a.m. this morning, 3.4%. That is the lowest rate in 25 months. And we're starting to see now the UK inflation look much more like inflation rates in the rest of the world, having been rather higher than the rest of the world for quite a lot of last year. Then, of course, just putting that inflation picture in the UK context and looking forward, my third theme is we're still going to get more deflation to come. We were talking before John and I, before we launched the webinar this morning, about the fact that possibly inflation, indeed probably inflation, will undershoot 2% as early as April. And through the summer, we'll see inflation, I suspect, starting with a 1, which, of course, is below the Bank of England's target, albeit that those big energy and food price indicators, which were such big impacts on the way up, now big drags on the way down, they've got to almost level off before you get a true feel for what inflation is. And that's one of the reasons why the Bank of England, I think, will be patient before cutting rates, because it'll want to see what, if you like, the underlying rate of inflation might be when you strip out all those really volatile components. And then finally, a point that I've made, I think, on all 4 or 5 of these webinars, and it remains the case today, household balance sheets, the amount they have as a net cash position after adjusting for mortgage debt and credit card debt loans, is actually still strong by historical context. Not all households, there are still a lot of households feeling some very significant financial pain. I'm not deaf to that. But at an aggregate level, as I'll show in the pack, that's a decent backdrop to expecting the UK to perform better than expectations. And for those who've been on the last few webinars I've delivered, I have tended to be a more bullish end of expectations. And I like to think the data has played out better than consensus and more in line with what we thought. Hasn't been tear away growth. In fact, barely been any growth. But versus the widespread expectation for a big and quite prolonged deep recession, UK economy has performed better, and that is encouraging. So, what is the global backdrop? Well, global PMIs, purchasing managers indexes. On the left-hand side here, you've got the lighter blue line showing the services sector, so that's hospitality, travel. This is what is actually the lion's share of particularly developed economies' performance. Has been strong actually in the last year, accelerated at the start of last year to anything above 50 is expansion. And then it slowed off, and actually going into the end of last year, services looked like it was going to dip into contraction, but actually it's picked back up again at the start of 2024, which is one of the reasons why central banks have been reluctant to cut interest rates. And while the manufacturing sector, the darker blue line, has been under the 50 marking for about 18 months now, actually it's starting to pick up, and it's close to passing the plimsoll line and being back into expansion territory. So again, the economic picture in aggregate is picking up at the start of the year versus some pretty pessimistic expectations at the turn of the year. Now that is in spite of global money supply. This is the amount of both notes and coins and deposits and loans in the circulation system being down at levels we really haven't seen in the last 20 years. That's the impact of higher interest rates, less lending, just less cash in the economy, which is designed to sort of stifle inflation and price pressures. Monetarism, as I'm sure John will ask in questions, has gone out of favor, but actually trying to slow the growth of money is part of that fight from central banks to slow inflation. And that dramatic fall you can see in the chart on the right-hand side in global money supply is, if you like, the translation of higher interest rates, making it less attractive to take on debt. Now, the stickiness of inflation, particularly in the United States, is a big theme as to why rate cuts have been delayed. Now, you can see in the US inflation rate on the left-hand side, big spike up like we saw in the UK, big spike down again like we saw in the UK, albeit slightly delayed in the UK context. But notice how it's kind of leveled off. And it's not leveled off near the yellow line, which is the 2% line, and indeed the average of the last decade. It's actually leveled off at about 3%. And that is a bit of a challenge. We hear from the Federal Reserve later today, central bank in the United States, on what their next move is on interest rates. And clearly in a backdrop where that progress back towards the inflation target seems to have stalled, and stalled for good reasons. The US economy has been doing well, certainly the strongest performing developed economy. That's one of the reasons why they felt no confidence to cut interest rates at this stage. And that, of course, is reflected in what other central banks and pricing in mortgage markets and debt markets has reflected that. And of course, that reassessment on the right-hand side, this is daily pricing of how much interest rate cuts we get from the US central bank this year. Back at the turn of the year, about 2/3 of the way along that chart, you saw that the market was pricing the US interest rates would end the year almost down at 3.5%. And bear in mind they're in a range of 5.25% to 5.5% at the moment. So, heading up towards 200 basis points of cuts. Of course, that's been reappraised, and that pick back up in the blue line is just a reassessment from financial markets, which is translating through to the pricing of debt instruments on how much loosening we'll get from the Federal Reserve. I still think we will get interest rate cuts from the Federal Reserve, just not on the scale that was perceived at the start of the year. So what does that mean for the major central banks and monetary policy? Apologies if you can hear the police in the background. It's not for me, I hope, but they're just passing in central London. The Federal Reserve is probably going to, in our view, do the first cut in July. Why July? Given the market thought it was going to happen as early as maybe February or March, and clearly that hasn't and isn't going to happen. Well, ongoing strong demand in the US economy, but also the US government, the Bidenomics, if you want to give it that phrase, very, very stimulative, very, very supportive for the economy, running big deficits, trying to boost demand. For the European Central Bank, a very different backdrop. We expect them to cut a month earlier in June. They want to see the data on wage settlements in the euro area, and we've had speeches from a European Central Bank policymakers in recent days saying, look, we'll know by June whether we've got a stubborn core inflation problem through wages or whether we're more comfortable. They've also got the challenge of a pretty multi-speed Eurozone economy. Germany, probably the poorest, it's rare to say this, isn't it? Germany, the poorest performing Eurozone economy, but an economy like Spain actually doing really rather well. And of course, you can only set one interest rate for the whole Eurozone area. So a really delicate challenge for the ECB. Now, the Bank of England, I think, will go in August. The market's not sure. I think it could go as early as May, could go in June, but our house view is August. Pull the tapes if I'm invited back another time to see whether I was right on that. Partly because of those, what I've described as indexation events to come in April. What's an indexation event? Well, the national living wage going up almost 10%. Your broadband contracts going up probably CPI plus 3.9%. Benefits, pensions going up well above the rate of inflation. I think the Bank of England, if you sat on the Monetary Policy Committee at the moment, you probably want to see how that plays out in services sector inflation, which we found out this morning was still running at 6.1%. You probably want to see that play out before you're ready to make a move on cutting rates. And the other point that's problematic for the Bank of England, they've been very public on saying this, is they don't have much confidence in the labour market data. We've talked in previous webinars about inactivity, unemployment, wages data. The raw data is something we, unfortunately, because of the labour force survey, the way we capture our information statistically in the UK, haven't got a lot of confidence it's telling us precise, accurate figures. So again, that probably suggests if you're not sure of the data, you'll be a bit more cautious on making your first move. So turning specifically to the UK.
Oh, Simon, so can I ask you just a quick question, particularly on the UK number? Is, obviously we've come in slightly below today in terms of inflation, in terms of February's number. If again that is repeated in March and April, which those numbers will be out mid-May, obviously that indexation issue is still there. So what in your would that help bring forward the cut from June, or do you think that indexation point and the data point is still there, that almost actually, unless those beats are huge, 0.1%, is significant, but it's not enough maybe to change their mind, even if it's repeated?
Yeah, I think the bar has been set quite high from the Bank of England I think it knows that inflation is going to undershoot 2% briefly in the second quarter of the year, and possibly even into early Q3. But they don't think that that's a stable run rate. And I've got a slide later that perhaps exemplifies that. And so while they'll come under big political pressure, I suspect, from Conservative backbench MPs, maybe not the Cabinet or the Chancellor, but backbench MPs saying, look, you should be cutting interest rates right now because it's below 2%. I think anybody who's done a little bit of economics will know that you're trying to make policy for 18 months, 2 years hence, and therefore the real volatility that might happen in the second quarter, low levels of inflation. I think in central bank speak, they'll try and look through that. A bit like they tried to look through the big increase in inflation initially before raising rates. They'll try and do that. It's a harder trick to pull off when you're undershooting. I think final way of answering your question is, how low would those misses need to be for the bank to lose its nerve and go, right, well, it's just very low inflation, we're just going to have to cut? I think it probably would need to be sub 1%. So some sort of form of inflation starting with a 0, 0.9, 0.8. If you get a year-on-year print like that, then that would make it very difficult for them to wait to August. So going back into the pack, second section, talking about UK real incomes, and this is, as I said on the intro, this is incomes for the average household, disposable income they can use to spend in shops, to take on debt, to purchase stuff, to save. There was expectation in the back end of last year from the OBR, November forecast, that would continue to fall, real incomes falling through 23, 24 into 2025 before it started to pick back up, the blue line. Actually, their reassessment in March is that actually we're already seeing real incomes grow, partly because of what's happened in energy markets. There's been I've shown in previous webinars the UK gas chart. It was I think I described it as the most important economic chart in UK macroeconomics. I haven't this time, but it is still a dramatic chart. The warm European winter and the supply of gas from Qatar, from the US, from Norway, that has boosted reserves in Europe has pushed that gas price right down. And we're starting to see that passing through to households and businesses and their cost of energy. And that is one of the reasons why, adjusted for that lower inflation, real incomes are starting to grow again. Now, this is nothing to get excited about. We're still going to be down this year on the levels pre-pandemic in terms of their real income. But there is a recovery from that low point that we saw last year when inflation was really eating into the purchasing power of wages. Now, we've talked a little bit, John's question alluded to this, that there's still actually some quite significant disinflation, not deflation, but disinflation, so a slowing rate of price growth to come in two quite relevant consumer staples and quite relevant consumer confidence, because people think overweight the impact of food and energy because they're quite visible prices. And of course, crucial staples. Now, if you look at on the left-hand side how food inflation has come right down, and particularly the lighter of these blue lines, that's producer prices. So that's further up the supply chain. That is the food producers reporting what their input inflation is, which you would anticipate will pass through to consumers with time, which is what the history tells you. But also use the global food price index, and this is the cost of soft commodities, wheat, rice, the crucial staples around the world. That's also in deflationary territory, negative price growth, those red bars. Suggests as we go through the year, food prices may possibly turn negative themselves as the component part of inflation, and that pulling down headline UK inflation. The other big headline drag is from energy prices. And the right-hand chart is either a depressing or a rather exciting chart, depending depressing where we've come from in terms of extraordinary ramps ups in the cost of household energy, inflation of almost 90% at the start of 2023. But now firmly in deflation in that component part. Now, it's only 4 or 5% of the basket. Might feel like more for some people, and it certainly is for some people, but that is now down to negative 20% year on year. And as we go through the year and we get the energy price cap reassessed in April and again in July, probably further decreases from a high point of £2,500 for the energy price cap back last year to probably something closer to £1,400 by the second half of this year. So quite considerable reduction. £1,100 for the average household is a material shift in the cost of a staple, which they find quite difficult to adjust the demand for. Now, again, I said I had a chart later to explain why the Bank of England might be a bit more cautious on core inflation. And this is stripping out those volatile elements of food and energy. And this chart here shows the G7, so the 7 major developed economies, their average core inflation rate, which chugged around 4% at the start of last year and has been it's the back end of 2022, has been coming down gradually. And the UK at the start and the end of that chart were pretty much aligned, but in the middle, particularly in April of last year, a big spike up in core inflation. And there were headlines about the UK had an inflationary problem that was out of kilter for the rest of the world. And I thought it was a timing issue, and so it has come to pass that there was a big indexation of prices in April when a lot of benefits, pensions, national living wage, rents are set. But then as that went through April, we saw price growth start to slow again and recouple with global trends. And I think we get something of a repeat next month in April. And you just want to see if you're on the MPC, and thank you, lucky stars, I'm not, but if I was and I was trying to appraise the data at the moment, I'd say I want to see that play out again, because it's going to be really uncomfortable if I start cutting rates and then we get prints showing big spike up in core inflation, which we saw last year and could repeat again. Now, it may not happen. Nothing is ever certain in economics. But I think the risk of knowing that data, the Bank of England likely to be a little bit on the sort of cautious side of making a big move. I mentioned the household balance sheets are in pretty good shape. And this is a chart which I used to show this chart in two component parts. I used to do the green line and the red line, and then a fund manager client said to me, he said, look, can't you put them on one chart so I can sort of see them, because there are two parts of the household balance sheet. So the green line being household savings, and this is the data we know that households across the country have in their bank accounts. They can access it, it's cash. And the red line being debt, mainly mortgage debt, but also loans and credit cards. Now, 15 years ago, 2007, when this data series started, households were net debt. They had more debt to the tune of about £650 billion. So the red line significantly above the green line. So an indebted household sector found it pretty difficult in the global financial crisis, and added a spike of unemployment in there, which we'll come on to talk about in a second. But over the last 15 years, debt in real terms, as adjusted for inflation, has come down. It's come down to about £1.8 trillion. Still a big number, but the green line has gradually, and during the pandemic quite aggressively, ramped up to close up. So in effect, households now today, at least at an aggregate level, it's certainly not the case for individual households, but at aggregate level, have the same amount of debt as they have as cash. And that is, if you're appraising, as I do and my team does on a sort of daily basis, the health of a corporate balance sheet, a company balance sheet, you look at their net debt position, how geared they are, how leveraged they are. And they're looking at UK households as a huge company. You would say their net debt position is considerably more favorable, more resilience to the last, compared to sort of 15 years ago. And that's one of the reasons I think why, and again, I didn't say this 18 months ago, I think it's one of the reasons why I felt that the UK household sector would be more resilient than many had feared in the face of big increases in interest rates. I said I'd mention unemployment. Unemployment is, I mean, I'm sure John will ask this because I know he's a great student of economics. It was not supposed to be this way with interest rate increases. Interest rate increases were supposed to increase the unemployment rate, which was supposed to bear down on inflation. And that'd be the way we get back to 2% price growth. Well, we've had the interest rate piece, but look at the unemployment rate, both the G20 level, the blue line, and the UK one, the yellow line. No real increase at all. If anything, unemployment rate continues to fall. It's a real challenge for economic models that have been built on this relationship between interest rates and unemployment. Now, you may say it's lagged, and many people accuse that of being the case 12, 18 months ago. Oh, it'll be lagged. Oh, when we get into 23, 24, it'll all change. Well, it hasn't yet changed. And it's a real challenge for central banks to understand the reaction of the economy to interest rate increases and how that affects and the interplay with inflation. But it's good news from the economic standpoint. If you're thinking about defaults or impairments to loans, big causal link between losing your job or fear of job loss and those impairments or defaults. And the fact that the unemployment rate in the UK remains 3.8% is an extraordinary data point and a very positive one.
So can I ask on this? I know we're going to come on to inactivity, but I just wondered if you knew, where you said obviously household savings or balance sheets are in a relatively healthy position, whether you have the same data or view, or is that the same for UK corporates? And if so, is it a case where UK corporates are sitting on resources, sitting on cash, and they're looking in the same way the Bank of England is looking through data, they're looking through and thinking all the data is suggesting any recession is going to be relatively mild. So rather than laying people off now, we'll just hold on to them, keep costs under case because we're expecting some recovery 6 months, 8 months, 10 months through the line. Again, is that a thesis that there's any data to support that there's a shadow effect of what's happening in households?
There is, there was a preservation of cash and a deleveraging in the corporate sector during the pandemic, using the various loan facilities, supportive loan facilities that were on offer, the headspace that was provided by amnesties on insolvencies to allow companies to restructure themselves. And it's left the corporate sector, and it's not universal. I mean, services slightly stronger than manufacturing, construction, quite a bifurcated picture depending on what you're exposed to. But actually at an aggregate level, yes, corporate balance sheets in pretty decent shape, not quite the same scale of improvement as households, but certainly the idea of there being dry powder in the corporate sector, which is stopping difficult decisions on employment and hoarding both skills and capacity for what they expect to be an upturn, I think is a story that has empirical foundings. Yeah, that's right. You flagged that I was going to talk about inactivity, and you're right, because of course we've got employment, we've got unemployment, and there's a third group, about 21% of working age Britons, who are inactive. They are neither in work nor seeking work, actively seeking work. And the big driver of that has been long-term sickness. Actually, for other reasons, the yellow line has been relatively flat in the last 4 or 5 years, but there's been a near 40% increase in inactivity amongst the long-term sick. And that's a really very difficult position. It's partly the NHS waiting list and the expansion there. It's partly mental health conditions and physical health conditions that were made worse during the pandemic. But it really is undermining the ability of the UK economy to grow at a faster rate, because there's that latent capacity that is there, which can't be tapped into. And one of the big challenges, whoever wins the next general election, and I think we all know who the answer will be, who it'll fall to, is to try and activate that group, make them available back to the corporate sector, but also allowing that group to earn income, be able to earn income, and therefore increase their own scale of resources. So, I mean, that is very striking. The other part of the inactivity picture is how much that is actually concentrated, despite some of the slightly more, I'm not going to get into the politics or the media sensationalism of this, or all this, but some of this gets wrapped up in immigration, country of nationality stories. I'm not going to get into the politics. I'll simply show you the data, which is on the right-hand side, which is the big spike in inactivity has been amongst the UK-born population. Whereas actually the EU-born population, and very dramatically the total non-EU population, so this is what used to be known as third country migrants, which has been the big influx of immigration. Actually, inactivity amongst that group has dropped pretty dramatically, almost 4 percentage points since 2019. So there is quite an interesting, if you like, picture now emerging of which cohorts of the population are inactive and, if you like, struggling to re-engage with the labour market. Got to try and have a bit of a forward look now in terms of what to expect from growth. Try and be helpful. Can't just the easiest thing for an economist is tell you what happened. Try and look forward. Well, quite difficult picking the bones out of UK GDP, or at least on a monthly basis, which is the left-hand chart, to know what the, excuse my French, what the hell is going on, because you've got some months of expansion, green bars, followed by a month of contraction, and it's a bit of a random walk, if I'm honest. I don't think the ONS should be publishing this monthly data. It's just too volatile. But if you take the 3-month rolling average, the dotted blue line, you can kind of conclude the growth is pretty much flat. It's around 0. And I've written, John's very kindly referenced my Times columns. I write every 2 weeks now for the paper, and I've written a lot about the fact that you can interpret that one of 2 ways. You can say, God, there's no growth in the UK economy, isn't that depressing, Or you could say, gosh, we've hit an extraordinary period of turbulence, 2 wars, 515 basis points of interest rate increases, inflation at 11%, and yet we've held the economy steady. We haven't had the big recession that was widely forecast and a big contraction. And I guess it's so wrapped up, unfortunately, in politics. But you can argue, that there's been resilience there, despite what looks a pretty sluggish growth performance, and versus some of the counterfactual fears. I would argue that's not a bad performance, and certainly not out of line with other major energy importing European economies, the likes of Germany, France, Italy, etc. Sector growth has flatlined on the right-hand side. Construction rebounded very strongly, but has since flatlined and slowed down. Services, again, rapid rebound and again flatlined. The one that has struggled, of course, has been production, so manufacturing. And that has been a real sort of Achilles heel for the UK economy, partly linked, I think, to Brexit frictions. But John and I chatted before we came online about the speech that Rachel Reeves gave last night, laying out the Labour Party's economic policy, and I think trying to energize the production, the manufacturing sector, and taking more of an active industrial strategy, I think is going to be a characteristic of a Labour government if it is to be them. And obviously this is for a disproportionately housing orientated interested audience. So apologies if I'm showing you stuff on this final slide. I think it's the final slide that you know. But one of the reasons why we've seen the household sector, the economy, the housing market hold up rather better than had been widely anticipated is that the interest increases on mortgages and unsecured debt, those two red lines on the left-hand side, has grown rather slower from when interest rates started to increase back at the start of 2022. Interest increased rather slower than the cash, the interest people have got on their savings, either cash ISAs or time deposits. Now, the challenge is that's going to inflect. You can also already see those green lines start to plateau as interest rates have peaked. But the darker red line, mortgages, of course, more people will roll off cheaper deals secured back in the late 2010s, early 2020s. They get a roll off onto more expensive deals, and that red line is going to progressively rise. So the debt servicing costs are going to increase. So I don't think we're completely out of the woods, but part of the resilience thus far is that pass-through of interest to people who have savings has somewhat offset the contraction amongst those who've seen their debt servicing costs go up. And the fact that the green lines have gone off faster than the red lines, I think, is illustrative of that. And what has this done to affordability? Well, I mean, everyone's got their preferred metric for housing affordability in the UK. On the long term, you would expect the value of a house to largely track nominal GDP, so cash GDP, cash size of the economy. And you can see back in the late 80s, early 90s, it fell below that red line, then a big ramp up in housing to the global financial crisis, and then a pullback, and again, a big ramp up in the aftermath of the pandemic. We start what statisticians would call two standard deviations away, which is kind of a stress point, I think, where valuations are really out of kilter. And part of that recoupling of the blue line and one of the dotted red lines is an encouraging fact that nominal prices, cash prices, have held up pretty well, allowing inflation to do some of the work in adjusting to a new interest rate environment. And I think that's quite encouraging in terms of psychologically, maybe people think in terms of cash terms, the cash value, whereas actually if you allow for the fact the price index has gone up 22% in the last 2-3 years, actually prices haven't kept pace with that. So in real terms, which is what we care about, what we really look at in terms of affordability, actually affordability has improved a little bit, still stretched by historical standards, but certainly inflation has helped take some of the painful adjustment out of that market. I did have one more slide, and that is on precautionary saving, because look, those of you who've been listening to these webinars before will know I tend to be cup half full. It's been a decent place to be. We've done okay with our forecasts, but I would be remiss of me not to say, well, what worries me, what keeps me awake at night, and it's not just my 9-month-old daughter, but it is also the potential for precautionary saving, households getting pretty nervous maybe about I don't know, a change of government, wars, potential unemployment, those kind of things that would lead to them going, gosh, we need a rainy day fund. A spike in the blue line, the UK savings rate. Now, historically, that spike in the blue savings rate, if we avoid the big blue spike, which is the pandemic, those spikes in the early 90s, 2008-9, was when we had a recession, a big pickup in unemployment. What's interesting on this chart is we're starting to see a pickup again in the savings rate, and yet unemployment remains pretty benign, the yellow line. So it is a bit of a difficulty. And if you're wondering why the Bank of England's pretty pessimistic and why I'm a bit more optimistic, I tend to think that savings rate will start to decline again, more households confident to consume, to spend, to keep the economy going. The Bank of England's more cautious. It thinks that savings rate will remain pretty high. And I'll finish where I started, which is just to put the UK economy's savings performance in recent times in an international context. And I'll focus on the US here, on the final chart on the right-hand side here. The US savings rate, household savings rate, has been less than 4% in the last couple of years, 3.9%. Now, that is 1.9% less than its long-term average, 20-year average. That is a US household feeling really bullish, really, going gangbusters in terms of spending, consuming, driving the US economy. Whereas more caution in the UK, EU, Canada, interestingly, Japan. Japan's always a slightly special case. But one of the things, of course, is while there are good reasons why the government's trying to overall encourage higher saving, it's not necessarily in its short-term economic interest, given the importance of consumer spending to keep the economy going in a sort of fairly sluggish pattern. So I'll be tracking this savings rate really quite crucially to understand who's right. The Bank of England more pessimistic, expecting households to be quite precautionary in their savings behaviour, or a bit more animal spirits coming back into the economy, which is my view as we go through 2024. John?
Fantastic. Thank you very much, Simon. And for those listening, we've got about 20 minutes or so for questions, so please do sort of ping them over. I will, in the messaging box at the bottom, I will just sort of start off, if that's okay, and on interest rates. Consensus now, as you said, you're expecting rates to base rate maybe to start falling in the UK in August. Obviously, there are some who think June, so that's 3 meetings or 2 meetings away. Obviously, obviously going to May would be 1 meeting away, which obviously, as you say, seems a little bit too soon. But whether it's August or June, consensus seems to be 3 cuts of 25 basis points before the year end, maybe 2 in some cases, but that sort of quantum. So we end up the year sort of around about 4.5%. Do you have a sense, and I know this is a very hard question, I thought I'd start with the harder ones, of where the new sort of baseline is? Where do they settle it? Is it 4? Does it begin with a 3? Or is it just too hard to get a sense of where that might be?
Look, short answer first, 3.5 is what I have in my long-term model for my medium long-term economic forecasts, which is higher than it was pre-pandemic, where I thought it was probably closer to 2.5. In fact, that was my assumption. And part of that is some of the legacy of the pandemic probably makes the equilibrium interest rate somewhat higher, and some of the economic responses to not just the pandemic, but also Brexit, Trump, protectionism, that adds a more of an inflationary environment than we've had in the last 20, 30 years. And therefore, I think the equilibrium interest rate required to stabilize price growth at about 2% needs to be a bit higher. So I think, look, it's a very inexact science. I don't want to give people the impression that anybody, whether they have Nobel Prizes in economics or not, really have a really very reliable model here on the long-term interest rate. But I think to provide those data points you opened up with, 5.25% the current bank rate. I think we've got a view that they cut in August and November, so 2 basis points cuts, 4.75%. You can probably see that accelerating a bit more in 2025 as you track back towards more of a neutral interest rate. So I think that's a reasonable expectation if you're looking on an 18-month, 2-year view, tracking back towards what most people would think is a reasonable long-term interest rate for the UK economy.
And on that, we've got a sort of slightly connected question in terms of what does today's inflation reading mean for swaps? I'm happy to start answering that. I mean, I think last time I looked, they were down a little bit, 5 basis points. As we were saying earlier, it doesn't materially change when the first cut is going to be for those reasons you mentioned, or where it ends up. So it maybe just makes it more certain that rates are going to fall, but it hasn't been a game changer. Obviously, if it carries on repeating a number of times, then maybe it would be. Is that fair?
Yeah, I think that's right. And I think this month's print and almost certainly March's print won't have a big impact on the swaps market. I think April is a big print. I really do, because of two very conflicting influences. The big disinflationary impact of the energy price cap, which will pull headline inflation possibly down to, sub 2%, quite probably sub 2%, versus the impact of those big indexations that I mentioned, pensions, benefits, national living wage, broadband contracts, rents, pushing up core inflation. Now, how do you pick the bones out of that? And so if you're highly sensitive to the swaps market, then that inflation print, which will come out in mid-May for April, I think it'll be a big moment actually for understanding what the path is, that interpretation, huge volatility, I suspect, on the day, but then also may recast the narrative in terms of what's a reasonable expectation and how quickly inflation will stably get back to 2%.
Yeah, and there's another one connected to that, which is more mortgage specific, so I'll answer it. But it's saying currently in the mortgage market, we're seeing consecutive rate rises for various lenders and a general consensus of upward trajectory, but swap rates are reducing. Why the divergence? Is it purely a lag in swap markets? Well, from our perspective, actually, if you take a sort of a view from sort of late January or mid-January, swaps actually been increasing, yes, but there's actually a lot of volatility. And so lenders, when there's a lot of volatility, you can get caught out. And so lenders, whenever you hear news from the Fed, and sometimes there's conflicting news on in inflation from different parts of the globe. So lenders have had to sort of build in a bit of buffers because I think they've been caught out at various times in January and February where swaps went against them, et cetera, et cetera. So I'm probably a bit closer to that than you are, Simon, but I don't know if you've got anything to comment on that.
I defer to your far superior expertise in that market.
And then, obviously we've got an MPC meeting tomorrow. No one is obviously expecting anything other than a hold. But just as a matter of interest, what do you look for? I mean, I guess there's two things. There's the commentary, the language, maybe forecasts, but also there's a voting split. Is it a case of how many people are going to be voting for a cut? Because there might be one or two members that vote for a cut, but there may not be. It's what does an economist like you look for really, and what should we be looking out for?
Yeah, for this monthly meeting, I think the second point you make on the vote split is the first thing I'd look for. So last month we had a 6-1, first three-way split, I think, since the late 90s, but it's a long time ago. 6 people voting for no change, 2 people still voting for a hike, and
that's a real surprise, isn't it? That even with all the data we've had, that there's people in the MPC still voting for a hike. And I noticed in the Times shadow MPC, I think it was Andrew Sentence, was also voting for a hike as well, which surprised me that some people
that doesn't surprise me, John. No, look, I huge respect for Andrew, but he is a perma-hawk. He's permanently hawkish, been calling for interest rate increases for all the time I've been a professional economist, which is 22 years now. And so I think we put those outliers aside, and Catherine Mann, who is the most hawkish on the MPC, still voting for a hike. She's pretty uncomfortable with the level of services inflation. As I said, 6.1%, wages inflation still running about 5-6%, not consistent with a long-term view of getting inflation down to 2%. So that's their view. Swati Dhingra, voting for a cut, of course, talking about really very soft demand picture in the UK, needs a bit more support given how low inflation is going to go over the summer months. They're both, I would argue, they're both respectable views, but you're just putting different weights on different parts of the data picture. But then's the second thing you look for. You look in the narrative of what the core internal members are, because those 3 policymakers are all externals. And to some extent, the role of an external on the MPC, not a bank employee, but an external policymaker, is to challenge the consensus. The internal consensus is, well, with these conflicting data points, with high level uncertainty, unsure of the data, we're going to just minimize our errors by sitting tight. And I think I'll be looking for whether that that narrative in the minutes changes from there's a lot of uncertainty, there's very conflicting signals, we're playing for time, to something laying out a bit more like the ECB, the European Central Bank, have done, have said, well, actually June is now starting to coalesce as quite a potential moment. The Bank of England have not provided a timescale. The ECB have. The Fed is somewhere in the middle. I think I'd be looking for any indications, any subtle language changes.
And I assume again that the internal members always vote the same way. Do you ever get disagreement, or do they always follow the governor effectively, or the chief? Who follows who? I don't know whether it's the chief economist or the governor, but I assume that those splits amongst internal just doesn't happen.
It's rare. It's rare. It's very rare, because they are largely presented with the same material from the internal staff members. So when you're presented it in that way, rather than relying, as the externals do, on a lot of their independent analysis, then you probably converge towards a view naturally. But then there's a human element of it, isn't there? That you have a sort of a community of internal deputy governors and the governor itself, and you don't want to necessarily. It's probably good life advice in the workplace anyway. Not necessarily a good idea to disagree with the governor, who
and publicly, effectively, because your votes are recorded.
Indeed. So while it has been done, it's pretty rare. And I don't think it's likely that you'll start to see members of the internal core, either the chief economist Hugh Pill or Dave Ramsden or Sarah Breeden, splitting off and join. I think they will move en masse. They'll move in one meeting from hold, presumably, to cut. And I think that would happen when they're presented with new economic forecasts in August, when they've got enough data on what's happened in that April indexation round. That's how I think it plays out.
And one I think, so again, connected, your sort of colleague in the Times group, David Smith, who writes the Sunday Times, but now it's online. I never quite know when the article's going to hit on online. But he an article I think I read yesterday, or maybe this morning, talked actually that obviously real interest rates, because inflation is falling, are obviously rising, and actually they're positive, and they've largely been negative or zero for most of the last 10, 15 years or so, and obviously now they're at sort of 2% to 2.5%, and obviously that in itself is a monetary tightening. Do you sort of agree with that view that as inflation falls, that actually just by doing nothing, conditions tighten? Because it's sort of slightly counterintuitive.
Yeah, so I have nothing but admiration and respect for. He is the doyen, isn't he, of UK economics journalism, and has been for decades. I don't think on this one, though, I particularly agree. I think if you look at real rates as purely arithmetically, the bank rate minus the CPI rate, then you introduce an awful lot of volatility because of the way, particularly at the moment, inflation is bouncing around. And I've always preferred to look at real interest rates and what inflation expectations are, either market-based expectations using index-linked gilts as your variable, or survey-based data. And now there's a far more stability in terms of expectations. And therefore, the idea that the things have whipsawed from being highly accommodative to now rather more sort of restrictive in terms of monetary conditions and financial conditions, I don't think stacks up with the way I think that most people think about what are largely long-term decisions. They have a view on what the real interest rate will be 10, 15, 20 years, the term of potentially their product, and therefore inflation expectations rather than a point-in-time estimate for inflation will be the better metric to look at that.
Okay. And then on to, obviously we had a budget a few weeks ago, which is kind of largely been forgotten now, and obviously there was not really any surprises. Obviously the main thing was that national insurance cut.
No surprises if you leaked the whole thing to the papers the week before.
Fair point. And I suppose obviously the non-dom tax thinning in Labour's clothes as such. Obviously, the expectation now is that there could be another fiscal event, if that's the right phrase to use, particularly if the election is post-October. With what we've been saying, inflation is coming down. That is going to lead to, even if interest rates aren't going to fall, base rate isn't going to fall for 4 months or so. You'll start to see gilt rates sort of continue to sort of likely to sort of drift downwards as that point gets closer. Obviously, we can also see that, again, month to month is hard, but GDP, there is some pickup in GDP. So there could be some further headroom, both from a sort of cost of debt servicing and maybe tax rates slightly higher. And again, it's a slightly political question, but so far those national insurance cuts haven't turned the dial politically in terms of opinion polls. They haven't done anything. But do you think they'll try one more time? Think, okay, this time another 2% off national insurance or 1% off income tax, and and do you think there'll be another fiscal event, or they actually they'll just go before then?
I think it's difficult to see another. Look, the way you've laid it out in terms of the potential for some more headroom is unimpeachable. It's very good summation of the public finances position. If growth picks up and RPI, which is relevant here because a quarter of the UK debt stock is linked to RPI, it's index linked, and that is by far and away the biggest index linked share in government debt across the G7. As RPI comes down, and it could go and come down quite a lot way further given what's happening in gas prices, that cost of servicing debt adds more headroom incrementally as we go through the year, particularly if RPI undershoots. So you are right, there could be temptation if you had a sort of point in time OBR estimate of headroom. You might go, well, there's another fiscal event we could introduce and give ourselves another go. But I'm not sure that, well, in fact, I will go stronger than saying I'm not sure. I'd be staggered if it moved the dial, indeed, either economically and certainly not politically. It might happen because you go, well, I'm a gambler and I'm looking at the opinion polls, and you might have some headroom based on what we have a line of sight for on debt servicing costs. But I'm not entirely sure it makes much of a difference either politically or economically.
Okay. And then sort of, I suppose, a sort of final question, if I can, which is, and again, this is both from what's been done by Jeremy Hunt and also maybe from what Rachel Reeves is indicating she may do. But there seems to me to be two major issues with the UK economy that's sort of holding back growth. One is that inactivity point, which is now becoming material. And that, I suppose, isn't structural. It's relatively recent. The other one, which is probably more structural, is productivity. And those two things, if you're coming in as a chancellor or you're Jeremy Hunt, you're thinking, right, these are the things that actually, to get tax receipts up or to be able to cut tax, we need to sort of solve these two problems. In terms of what Jeremy Hunt did, which most of those measures were in the previous budget, in the autumn statement, and what Rachel Reeves is saying, can you see anything there that that may move the dial? Because they're constant challenges, really, those two things.
Yeah, they are. So the OBR estimate that those national insurance cuts do bring about the two sets of national insurance cuts, the ones in November and in March, or announced in November, announced in March, combined bring about 200,000 people back into the labour market, which is helpful from an inactivity standpoint, albeit against a denominator of 9.3 million people working age and active. That's still a relatively small quantity, but no, make no mistake, the fact they're going for national insurance when the easier sell on the doorstep, if you're being nakedly political, would be to have cut income tax. But actually, national insurance, employee national insurance, is more targeted at employment income, which encourages at the margins going back into work versus being inactive. And you're always thinking about the marginal deduction rate of leaving inactivity and going into work and what you might lose. And therefore, I think I give Jeremy Hunt quite a lot of credit in my columns on this for going down that route when the easiest thing politically would be to have gone with income tax reductions. Productivity we've spoken about previously on this webinar, and look, it's a multifaceted challenge. I'm not sure I heard anything from Rachel Reeves last night which was going to dramatically move the dial on productivity, but I'm not sure you can dramatically move the dial on productivity. The one thing I would say is that both governments have really twigged, and this is more my industry, so now I'm getting back onto my safe space, having been comfortably in your safe space, John, which is financial services, financial sector deregulation, and particularly trying to encourage investment spending into the UK economy. I think both sides, and particularly the Labour government, are pretty comfortable with trying to funnel pension investment income, ISA income, with more of a home bias. Now, some people on this webinar will have a shiver about, well, that wasn't what I learned about, diversification geographically, etc. But one, I think, has to acknowledge that if you undermine the amount of capital flowing to your domestic economy, then in that competitive race for green energy, for technology, the kind of things that are productivity enhancing, you potentially lose out to the US, where they are, the US is constantly held up as this bastion of free market economics. Nothing about Bidenomics looks particularly free market, or indeed Trumponomics. It's very protectionist. The CHIPS Act, the sort of the Inflation Reduction Act, all very, very protectionist, trying to boost capital into the US economy and try to insource activity from overseas. I think actually Securenomics, the Reeves agenda, and Jeremy Hunt's talking a similar sort of game, although he's got a bit more ideological hang-ups, they want to try the same approach for the UK economy. And that's possibly one of the things that will be different in terms of driving productivity going forward. I'm front running actually my column for Monday, because I'm going to almost certainly write about that. So the Landbay viewers have got a pre-release of my column for Monday morning on that.
Well, thank you very much for that, Simon. As ever, we seem to cover so much ground in sort of 55 minutes or an hour, and thank you very much for your time. And we all look forward to speaking later in the year to see if your August prediction is correct.
Thank you. It's been a huge pleasure.